This guy needs no introduction. He's all over the internet. Great YouTube channel. If you're not following him, make sure you're following Greg Dickerson. I've been in this industry a long time. But Greg, for those who've been living in a box and maybe don't know you and don't follow you on YouTube, just a quick brief of your bio and what you're up to in this space. And we're gonna get into a lot, especially real estate and crypto today. But give folks a little context on kind of where you've been and maybe even more focused on what you're doing today.
Yeah. So my entrepreneurial journey began in 1997. So I'm a serial entrepreneur, real estate developer, real estate investor. I also invest in stocks and crypto, and real more heavily in crypto here over the last year or so. I didn't go to college, went in the Navy right out of high school, did 4 years, got out of the Navy, worked a couple of corporate jobs, and always had a side business. And then, like I said, in 1997, I started my first little company, a little remodeling handyman company, built that into a $30 million business in 7 years, sold it, started 12 other companies along the way, sold all those and reinvested all the profits into real estate, started developing commercial, multifamily, mixed use subdivisions, things like that. So that's what I've done my whole career. And so now I'm on the back half of my career, and I've got my school of entrepreneurship, where I have courses and coaching programs, I guess like you do as well. And then, like I said, more so in the last year or so, mostly focused on stocks and crypto with the way the markets are and the volatility, with the markets right now.
Yeah, so let's jump into that. I find that incredibly interesting. So I mean, what is that conversation? Let's say we're sitting down. I mean, even right now we're sitting around. Let's say we have a cocktail in our hand and we start talking about investing. You're big into crypto and stocks. I mean, what's evolved or what's changed? Do you think that's giving you an eye towards this? And then I want to get into how that's impacting real estate. But what fundamentally has changed for you that's gotten you interested as an investor in this?
So I'm opportunistic. So I look for value wherever I can find it. I look for big moves, big swings. And, my first, jump into the markets were in 08, 09 at the bottom. That's when I got into the stock market for the first time. So I'm not afraid to take big risk. So for everybody listening, stocks and crypto are extremely risky right now, extremely risky, given the current economic environment we're in and with the Fed pulling back. That's why I'm interested in it right now, because you got a lot of big moves, big swings, and that's what I like to do. I like to catch the bottom of these big swings and then, sell them at the top. So swing trading is more longer term positions versus day trading. I will do some of those if there's big moves. Like I was scouting Netflix today. It dropped 35%.
Wow.
So yeah, I had a buy order in at $205. It didn't hit it, but it might, there might be some more downside coming. But that's the kind of stuff I look for. I look for stuff that's, have these huge drops, but it's still a good company. They still have good revenues. It's just repricing, right? Kind of like distressed real estate.
Yep.
So to me, stocks are kind of that way. Crypto is a different animal because you have Bitcoin, which is one thing. To me, I look at Bitcoin like digital property, and that's how it's classified by the IRS. To me, Bitcoin is like a piece of real estate. And cryptos are different. Cryptos are like companies, or like venture capital or equity capital. So I look at those separately than I do Bitcoin. And in venture capital, you can put bets on, 20 or 30 different projects. One of them may pay off. Bitcoin is more longer term. It doesn't have the attributes of these other projects. It's more of a, consistent thing that is what it is moving forward. And a lot more people are interested from an institutional scale in Bitcoin and Ethereum, which is more like an internet kind of play, like a browser. I look at Ethereum, kind of like Microsoft or Google or something like that. It's a bigger play. The institutions are more interested in those than some of the other, just basically, what are amount of pyramid schemes. And what a pyramid is, you bring more money in and the people at the top get paid, and you got to keep the money coming in for the pyramid to keep going. And a lot of them are flat out, schemes. So you got to be real careful.
So like allocation your portfolio when you say you're in crypto right now. I mean, is this 10%? Is this 50%? Is this 1%? Like how focused on this are you really?
Yeah, it's a very small percentage right now. I'm probably heavier than I should be. So it's 10 to 20% on any given move of total cash. So, stocks, I'll go a little heavier, but, crypto, it's very fickle. You have to be real careful because you get big moves up and down, daily, and you just never know when the rug can get pulled out from under you. So,
Right. Right.
That's not something you want to take big risks in, but I know a lot of people that are all in.
Yeah. Yeah, it's very interesting. I mean, the more you get into this crypto crowd, from a real estate investor, I'm sure you remember the days. It wasn't that long ago, 5 or 6 years ago, where it was like real estate in the real estate crowd crypto was like, don't touch it, you know, in the sense of like, who knows where it's going to go. I think all of those folks wish they were in crypto now, right? So,
Well, that was me. I mean, I first heard the word Bitcoin, I don't know, 2015, 2016, somewhere around there. And it was a guy that was working for me, one of my subcontractors, and I asked him how he was doing, how was business. He said, I'm retiring. And I'm like, you're retiring? He said, yeah, Bitcoin. And he showed me his phone and he had $800,000 in Bitcoin. I think he started with like $2,000 or something. I'm like, what is this? So he starts telling me about it. And of course, I look at it, I'm like, man, that's just crazy. That's not even a real thing, So I started watching it. And I watched it go up to 6,000, drop down to a few $100s, and it went up to 20,000, drop back down to 3,000,
right.
and then when it rallied up to 20 and dropped back down, in March of 2020, I started really paying attention to it after the pandemic sell-off because I was watching stocks and I was watching crypto and I'd been tracking Bitcoin. And I saw that floor get put in right at about $3,500. And I said, you know what, that's what happened the last time after, the 2017, 2018 peak. It dropped down to about $3,500. And I'm like, here's, the worst economic uncertainty we've seen since 2008 and 9. And it floored at 3,500. So I felt pretty safe to go in at that point and, make some trades, but I got out on the way up. Once it hit 20, I was out. And then I had no idea it would go to 60. So, now I've seen where it can go. And, like I said, in real estate, as a developer, as an investor, if I can make 20, 30%, on a project, that's kind of what developers shoot for, right? And investors shoot for. You can make that daily and multiple times a day on these crypto plays if you know what you're doing. So that's where the kind of light bulb went off for me is, looking at it from that perspective. And for everybody watching, you don't need a lot of money. You can start with $1,000. I think it is. Yeah. If you start with $1,000 and you make 100 trades or, plus or minus, and you earn 10% on each trade, that's $1 million. So, I mean, you could do the math a number of ways and say, hey, if I want to make $1 million off 1,000, you can reverse engineer that a lot of different ways, whether it's daily or whatever. But really with 100 trades, plus or minus, might be 97, 98, the exact math on it, you can turn $1,000 into $1 million by making just 10% on each of those trades. You're not going to win them all. Some you'll make, some you'll lose, but averaging out, over, 100 trades of a positive 10%, that's how easy that is in stocks or in crypto. And that's what's kind of interesting about it. And then there's some, you can get that in one trade, if you get into the right thing at the right time.
So, let me talk about your how you're hedging that in portfolio, but then I want to get into how you see this influencing, impacting real estate and as a whole. I mean, as an investor, Greg, you're an entrepreneur, you're an investor. Are you still long on real estate? And hey, this is kind of a, if it works, awesome. If it doesn't, well, at least I'm still backed by what I know. Or are you moving towards, hey, I'm long on crypto? I mean, tell me your philosophy there, just as an investor, and kind of how you're thinking about this long term.
Yeah, so I'm managing my own fund, so I'm looking for the biggest margins I can find with the short, least amount of time, energy, and effort possible. And with the way the markets have been lately, that's just where it's at. So I'm still a real estate guy first and foremost. That's where I came from. And to me, that's where my preservation of wealth plays are. That's where my long term is real estate. Stocks and crypto are my speculative games right now because real estate's just maxed out. We're at a tipping point in real estate right now. So I'm not really doing a whole lot there because my business model is different than a lot of other people. I'm not looking for the, value add kind of thing, that type of stuff. I'm an opportunistic, investor. So I still like to do heavy value add, ground up, opportunistic kind of stuff. So, I'm through all my projects as of the end of last year, but, right now, where I'm really focused is, the stocks and crypto, because these markets are going to bottom out and then we're going to have, opportunities like we haven't seen since 2008 and 9. And really March 2020, that was a life-changing opportunity for a lot of people. That one was a really, really good time. So once I get through these cycles, then I take that and put it in real estate long-term.
Wow, you just kind of maybe changed the direction of my conversation. I really want to,
well, you have to know what you're doing and you got to be on it, so it's not like this isn't easy, it's and you have to be willing to take some risk, but there are some big game-changing moves coming up between the stocks and cryptos, once we, bottom out and we get some more clarity. I mean, we have the war going on. We have the Fed just getting ready to get started. They haven't done anything yet. and the markets are already reacting and anticipating what they're going to do. So we've got a lot of things that we're dealing with, and we haven't seen the full effects of the supply chain issues we're having in China right now because of lockdowns, rising interest rates, the inflationary environment that we're in. Inflation is real and it's getting worse. We haven't seen the effects of those things yet. So you got to be real careful. That's why the markets can be good if you know what you're doing. But at the same token, you can get wiped out quick because markets can tail off from here and take years to come back. So you got to be real careful.
So speculate with me a little bit, Greg. We're not holding you to anything. Would you say that do you fall in the camp of inflation's there because of supply and that will essentially work itself out over the next several months as that bottleneck eases up? Or do you think, this continues longer term and that's going to have a bigger impact on the real estate? I mean, you talk about you're kind of out right now waiting for bigger opportunities. What is that? Because I don't know. I think maybe go. Why don't you
real estate's repricing because of interest rates. So we're going to go through a retrade repricing, which we've gone through in stocks. On the inflation point, some of it will subside when supply chains open a little bit. Asset inflation is already starting to reprice. Well, it's deleveraging. So we had the first down leg, which was deleveraging. Now we're going through a repricing. Companies like Netflix, when real earnings come out and real effects of where we're at in the economy, stocks will start to reprice. Cryptos are a little bit different from that aspect because there's a big network effect right there. And it's kind of the meme, factor at play there. So ultimately long term, Bitcoin is going to reprice. Some of these huge targets that a lot of people have just aren't realistic. Right now it takes too much capital and there's a lot of manipulation and, a lot of fraud going on in that industry. So that this still needs to be worked through for that price to really level out where it's going to end up going. And especially for Bitcoin, becoming that store of value that it was, really ultimately going to be like a digital gold. But as far as inflation goes, you have real wages that are increasing. That's not going to go, back up anytime soon because you still have more jobs and you have people willing to take them. So that has to correct before you'll see wages come down or, change. So prices have adjusted to, compensate for wage inflation. You've got a lot of companies now that have pulled back that are producing less but making more. That's going to continue. There's really no incentive for a company to produce more with less margins when they've realized, wait a minute, we're way more profitable producing less and charging more. So that's going to continue. Automobile manufacturing, for instance, a lot of the companies are talking about, well, we're not going to ramp up production. Of course, the oil industry until we become self-sufficient from an alternative energy standpoint, fuel is not coming down anytime soon. And there's no incentive for, oil producers to reduce their prices if they don't have to. So, some of this will subside, but the effects of the war and what we need to do to replace, the stock there, we have to ramp up defense spending, replace all the munitions that we're sending. We have to continue to build our military. So that, stimulates the economy there, which creates more inflation. So, really the only way to get inflation in check is to put the, economy in a recession. And right now there's too much demand. Right now they have to really raise interest rates to a level that's going to really slow down demand. And for people that don't understand the correlation between raising rates and, tapering inflation, when you raise rates, it gets more expensive to do things. So companies can't borrow as much. Homeowners can't pull equity out of their homes and borrow as much because house prices are going to correct and come down. So they can't tap that equity. It gets too expensive to do it. So that, sucks the liquidity out of the economy out there and creates, contraction, which creates stagflation, right? So you have low growth and you have high inflation. So that's kind of where we're heading. So I don't see any of this inflation subsiding anytime soon, but some of it will once, general supply chains open back up.
That was a quick masterclass on microeconomics, by the way. If you need to record this podcast and go listen to that again. But I mean, what I'm hearing you say doesn't necessarily change the strength of the economy right now, right? So I guess what I'm questioning for you, Greg, is like, you say you're kind of you finish out your projects in 2021 and waiting for the next opportunity. Correct me if I'm wrong here, but I just didn't hear that in what you just predicted. Yeah, we're going to raise interest rates, but it doesn't seem like we're heading towards big recession. Am I wrong in that? Or help me clarify kind of your position of I see some bigger opportunities coming in the real estate, maybe a repricing. Clarify that for me a little bit.
Yeah, so I see, from a recessionary standpoint, recession is just negative growth, 2 consecutive quarters.
Yeah.
You're going to get that when price is correct.
Mm-hmm.
So, you're going to have right now, we've had positive growth a lot because prices have gone up so much. So there's still a lot of demand out there. Until you destroy demand, the economy is going to remain strong. And what the Fed is saying right now is the economy is really strong, so we can really raise interest rates. Well, most of the people, like millennials, they've never seen rates at 5%. So that's a mental threshold and a financial threshold for a lot of people, a lot of millennials out there, when it comes to credit cards, when it comes to mortgage rates, things like that. So it's going to take a while for those things to kind of work their way through the economy to create any kind of a slowdown. And again, right now you have more jobs and you have people willing to take them. So generally, a recession is created with low demand, which creates unemployment. Companies lay off, they cut back, things like that. Right now, we can't even keep up. So there's a little bit of a correction there that has to happen first before you can round the curve to a recessionary environment, which ultimately is what needs to be created to bring prices back in check. Remember, the Fed's mandate is two things: stable prices and low rates. That's their low inflation. Stable prices and rates. Low rates and stable prices. That's their mandate that they have at the Fed. Or I'm sorry, employment, full employment and stable prices. That's what they're trying to do. And the two kind of correlate with each other. Now, from the standpoint of the moves I'm looking to make, I'm waiting for real estate to reprice, because as rates go up, for investment properties, cap rates will adjust, prices will come down. We're already starting to see deals fall apart, retrade, lenders backing out. You're already starting to see a little bit of those effects. The residential market, same thing. So as a developer, I don't want to go out there and take risk and build a bunch of houses now at current cost. And then 6 months, 9 months, 12 months down the road, I'm delivering these things when prices have dropped, 10, 20, 30%. And, that's a big correction, but it will happen in some markets, in some areas. Once rates reach a certain point, you will get, a correction in those prices. And we've seen it happen over and over. 2018, last time the Fed raised rates, the real estate market came to a halt. But from a commercial real estate standpoint, it's all about cash flow. And, you've got to, maintain a certain debt service coverage ratio. So, if your rates are at 5%, you can't pay for a 3 cap, stabilized 3 cap and make that work unless you bring additional equity to the deal. Then, that's not going to work because you can't pay it back. Rents are the big thing that concern me in the housing market, because they've grown so fast to a percentage of income to where it's getting to a point where people are moving because they can't afford the rents. And governments, municipalities are taking notice, and they're talking about rent controls. So, that's what happens, when you start getting ahead of the curve on rent growth and things like that,
Right.
when wage inflation is not keeping up with rent growth. So, those are the things I'm seeing. So I'm opportunistic and I'm optimistic, but, I'm waiting for that correction. I want to see what's going to happen. And, I could be totally wrong and things keep going, but that's not what history tells us.
Well, that's really
You can
interesting.
track.
I mean, we're boots on the ground. We're making offers, buying deals in some of the hot markets like Dallas. I don't see any price retrading, but here's what I see happening right now, Greg, is that sellers are very motivated to get things. If they want to sell, or if they don't want to hold on to these deals for longer than 24 months, they want to get something under contract, which, is, I think, maybe creating better terms for buyers. Price is not the most primary, is not the most important thing anymore. It's terms, it's certainty of close, which if you're a buyer and you're long-term on a market or an asset, that could bode very well for you, because now's the time to start owning some deals. But again, make sure you're long-term, make sure your DSCR is really good. But I am seeing that on the ground of like things are beginning to shift, not necessarily fundamentally wise, still getting strong revenue growth, rent growth. I'm just seeing from almost like a mental shift happening, and that can be very big though. And that you're right, that can trickle down into a lot of things. So that's really interesting that you point a lot out. Let me ask you a question. Still don't understand this. Call it youthfulness. Today, as we're recording this episode on April 20th, 420, mortgage rates, 30-year mortgage rates are 6 point, what did I just look that up? it might just, it almost like feels weird to say that out loud. So I need to say that 6.75. Is that what I just said? Yes. 30-year fixed average rates are 6.7. That's almost 7%. Greg, that's insane. Well, I don't know when's the last time we've seen that. But commercial rates, SOFR is still where it's been for a long time. What is causing that? Why is that so different where we're being quoted 4.25 on large commercial loans where 30-year mortgage is almost 7% today?
Yeah, it's a different animal. And when you look at that number, that's not for every borrower in every market. That might be an average or something, but you can still get rates lower than that. But generally, it's the investor pool going after those deals. So, commercial is different than residential from the capital that's going into those deals and the institutions. Of course, you have Freddie and Fannie that, are government backed. They have a pool of funds that they're trying to put on the street. So it's capital competing for deals. Whereas in the residential market, it's a very different animal, very different amount of capital, going after those deals. And that's based on the 10-year note, right? So what the investors are looking at is they're looking at, okay, 30-year mortgages are X, treasuries are X. Treasuries have no risk. They're guaranteed no risk, premium on that, whereas real estate has risk. Mm-hmm. And residential has, more risk than commercial, because right now commercial is seen, especially multifamily, as the lowest risk segment of the real estate market right now in terms of risk profile, even versus single family. So it's all about the capital chasing the deals and, the yield that you have to offer to attract the capital. So as rates go up, yeah, it's funny you say that. Like my first house was, 9% interest rates. And, I'm used to seeing, 9 and 10% interest on construction loans, things like that. So where we've come from is a very unique environment in the history of the interest rate, cycle. And, the Fed's been trying to get that rate up and they haven't been able to do it. So, we'll see where it ultimately ends up. But, when you start talking about mortgage rates, if it really gets to the point to where it's 6%, I mean, you're talking about the affordability, of the average home being cut in half.
100%. I mean, think about California, man. That's a dip. That's not even house. That's neighborhoods in terms of affordability. You know what I'm saying? It's not like, oh, I got to buy a smaller house. No, dude, you don't even get to move into that neighborhood anymore.
Yeah. And the biggest risk out there is a lot of these deals, especially in the commercial space, have all been done on, floating rate debt.
Yeah.
So there's a lot of those that are going to reset. So if you bought a deal with a floating rate, and you didn't buy a cap, well, you're in real trouble if the rates adjust to, 5
well,
or 6%.
The cap's only 2 years as well, right? So some of those caps are going to expire here real soon as well. But I mean, again, we haven't seen this though. Like rates are still low. I mean, again, we're still being quoted 4 right now on our commercial loans. So yeah. I haven't seen that movement happen in the commercial space yet. Not to say it can't go there. We'll see what the Fed does in these next meetings, but that was my
yeah, you got to get north of 5% in the commercial market to really start making a big dent.
Right.
But, there are, like I said, there are some pockets and, the people I'm working with, we're starting to hear, pushback. We're starting to see lenders pull funding at the closing table. So you'll start to see some of those things happening. And, I'm hearing it out there in different areas, but, Freddie and Fannie still have a mandate. They still have a pile of cash they got to put out on the street. So that's why that's happening right now. Once that resets, it's going to go up. So they're still working off that previous pool that they've got commitments at those levels. So once they, once that's done and, the Fed prime rate, and the other thing is the Fed hadn't done anything yet. So that's the other thing. So they haven't done anything yet. So we haven't seen the rates actually, well, I mean, what they hike, 1/4 of a point.
Quarter.
So yeah, that's the big thing. It hasn't happened yet. So once that Fed funds rate starts going up, the next 1/2 point rate hike, we'll probably start to see over 5%. And if they start releasing their balance sheet, they're selling treasuries into the market, that's going to jack treasury rates up. So it's going to be very interesting to see, when the Fed actually takes action, what the results are going to be. But it doesn't happen overnight. That's the other thing. So a lot of people don't realize what I'm talking about. This isn't going to happen overnight. Rates have gone up in the residential market pretty darn fast. That's a lot faster than I thought they were going to go up. But even that, because of the inventory levels in the residential market and the amount of investor cash buyers that are out there. Granted, a lot of those are levered up. The institutional cash buyers are levered up. That's going to stop because their borrowing power is going to dissipate as rates go up. But very different environment. So it's going to take probably 6 months or so to start to see a huge impact in the residential housing market with rates north of 6%, if that's where they are, and you can't get a better rate than that. But commercial takes a little bit longer.
Yeah, yeah. I wish we had time for another beer so we could talk about. Well, let me at least get your input on this. I need to have you back on the show to talk about this topic because I know you're interested in it too. NFTs and kind of their impact on real estate investing. How much have you went down that rabbit hole that you can share in the 10 minutes we have together?
Yeah. So I've got a great video on my YouTube channel where I did an interview with Proppy. They are the ones doing these real estate NFT auctions where they're auctioning off properties as real estate NFTs. But long story short, what they do and what it is they create an LLC that owns the property. They file it at the courthouse so that it's filed once. And then that way they're selling that. They turn that LLC into an NFT, which is just a digital file. That's all an NFT is. And they sell that. Now the digital file has some properties in it where the owner and the broker can pay a royalty every time that NFT sells, which I've done in development deals, by the way. You can put that in the deed, as a transfer fee. Every time the deed transfers, you get paid as the developer. Just a little nugget out there for anybody who's developing, where you can get ongoing royalties. Some states you can't do it, but so that's really what it is in a nutshell. They're just recording an LLC at the courthouse, deed, and then they take that LLC and that's what transfers from that point on. So you never have to go back and re-record. So anybody can buy that NFT anywhere in the world and own that property because it's basically just an LLC.
Interesting. And do you think that's something that you would begin to, as you start to, develop again, I don't know, like how they're doing that as a company, but how do you see that kind of coming mainstream and maybe impacting your investment strategy or the way that you do deals in the future?
In terms of the technology of the blockchain where these transactions are recorded, I can see that becoming more and more of a thing because it's so much more efficient than, literally recording a piece of paper at the courthouse. So will that ever get replaced? I don't know. Will it all go digital? I don't know. So that's ultimately the efficiency of what's transpiring and what's happening. Real estate's tricky. So it can work for certain properties that are just postage stamp. Everything is good. You do the title search, meet and bound, survey, all that. And nothing ever changes. You can't develop it. You can't change it. It can work for those types of properties. But when you get into more complicated, tricky kind of properties and you try to subdivide, that's where it gets a little bit more complicated. But if you're talking about a condo in a building or, a single family home on a postage stamp lot, it's all pretty straightforward. It works. And basically the whole idea is it just streamlines that transaction from soup to nuts, and it can be done instantly versus having to go 30 days or whatever it takes to do all the different things. Problem with real estate is you have all the inspections, things like that, and you have fair housing, and you have all these other different things that can kind of complicate the process. So it's
right.
There's only been 3 of them done so far, so we're at the very beginning of where this ultimately can go. A real estate NFT is nothing more than simplifying and digitizing the recordation of title and ownership. That's what that is. So that ownership can be instantly transferred through a digital, format. And then you get into tokenization, which is a whole different thing, and that's almost like syndication where the tokens are shares and, you're selling shares, but that gets into, SEC and, even more complicated than a syndicated LLC, as far as the tokenization goes. And then you have to have somebody that kind of tracks all that stuff and, things like that. So, it's early and it's complicated, but it's ultimately can simplify and streamline, real estate recordation and transfers.
Which I think we both would agree is prime for disruption. So, the blockchain's not going anywhere. It's here to stay. It's going to impact every arena of our lives. To think that it wouldn't impact real estate, I think is naive. So, we'll see. You're right. Really curious to see how this flushes out. I don't know if you've heard about, I'm sure you know Michael Flight. He's hosting, and I'm actually co-hosting with him, the Blockchain Real Estate Summit. And so, Greg, we should figure out how to get you on stage, man. But for anyone listening, if you're interested in that topic, go to blockchainrealestatesummit.com. and that's going to be in Austin, Texas. That's a live in-person event. I'm really excited to be attending and hosting. And so, Greg, invite you as well. blockchainrealestatesummit.com. Go check that out. That's later this year in Austin, Texas.
Yeah, cool.
So, Greg, this was fascinating. Really great combo as always. I know we've gotten to speak a few times together, and I just love hearing your perspective on the market and deals and entrepreneurship. So, thank you. I'm a big follower of your YouTube channel as well. And so, guys, make sure you go check out Greg's YouTube channel. This will be on YouTube, on my YouTube channel at Ellis Hammond. And so, make sure you're following us both there. Greg, besides YouTube, where else can folks follow around, or is that the best place to go learn about you?
Yeah, gregdickerson.com. That's where all of my social media profiles live. All the links are there and everything I do. So gregdickerson.com. You can find my YouTube channel there, podcast, and Facebook, Twitter, all that good stuff.
Awesome. gregdickerson.com. Guys, go check him out. Thanks again, Greg. Appreciate you, man.
Thanks for having me.
All right.